Well, the Financial Times in London were very widely read. Had a headline that this is the biggest policy mistake ever. We feel that's a little bit unfair. Look, certainly, I mean, the Federal Reserve painted themselves into a difficult corner last year where, in order to maintain their credibility, they did have to hike. They had talked about it right across the year of 2015. I think on reflection, they should have gone in June. There wasn't any real issue in emerging markets then. Oil hadn't really sold off to the levels that were causing these large stresses. I think they were telegraphed to go in September, but the Chinese currency depreciation of August really roiled that plan, and they got spooked, and they did pass on September. But they went in December, despite markets not feeling that it was entirely appropriate. It was maybe very late in the cycle. This has been a long period since our last recessionary episode, and we know that we're very mature in the credit cycle, and credit spreads have been widening since 2014 now. Credit spreads tend to lead equity markets by a considerable margin. Certainly, over the course of the last 15 odd years, they started to widen, well before the crisis in 2007. They started to narrow when the markets had sold off well before equity markets hit their lows. And so they do tend to lead that cycle, and they've been widening for some time. If we've been looking at that spread widening, and that spread widening is the market saying to corporate borrowers, we demand more from you. We need you to pay us more in order to fund your debt obligations. If we regress that spread widening that we've seen since 2014, it has pointed to materially lower equity markets with a target on the US S&P of around 1700. Now, interestingly, that 1700 level is down about 20% from the highs posted around 2100. And historically, under QE programs, we've seen stimulus for the market at that level. So when the Federal Reserve finished QE1, the S&P dropped roughly 20%, and they immediately launched QE2. When they finished QE2, the S&P dropped 19%, and they immediately launched Operation Twist. Operation Twist they tried to stop early, and we had what was famously referred to as the taper tantrum, and they immediately extended the program. So you've seen a history of Federal Reserve action, which speaks a lot louder than words in our view, of support for the market around those levels. So we get more comfortable with the asset with financial markets off those levels, but it will require the Federal Reserve coming in and talking down any further movement in rate hikes, and then potentially looking at some kind of stimulus program. I don't think we'd go straight to a QE4 scenario, but certainly an Operation Twist style program again could absolutely be on the cards.